1998 turned out to be a great time to start a private equity firm because the past 2 decades have been pretty incredible.
Yeah.
Private markets have outperformed public markets, and there's been some pretty amazing results. Tell us a bit about that story and some of the numbers behind the private markets growth.
Yeah, so well, I think it all comes down to outperformance of the public market. So if you look at on an average basis, private equity outperforms public markets on average by about 5% per annum. So that's on an average. If you actually start to really look at the best managers in the world, that outperformance goes to 10 or 15%. So
Wow.
if you're seeing public markets perform in that sort of 8 to 10% range over the long term, private equity is more in the 20% plus at the top end. That outperformance is real, and it has, as you've said, been sustained over 2 decades.
So like rough numbers, you're doubling your money every 3 to 4 years rather than like 7 to 8 years.
That's correct. That's exactly right.
Yeah, geez,
Within private equity.
that compounds.
Yeah. Yes, it really does.
We need a podcast, private equity, mate.
Yeah, that's right.
Yeah. All right, we'll take that offline. Maybe you can co-host with us.
Yeah.
So Cameron, I guess the question that follows then is, what do you actually attribute this outperformance to?
I think it's really clear. It's actually a better governance model. So if you can imagine what happens, and I've sat on some public company boards as well, it becomes a real division between shareholders, board and management. And you have a lot of discussions at a board level that aren't really about creating value. They're actually about checking boxes and remuneration committees and all these types of things. And obviously the shareholders are one step removed from the management as well. That doesn't exist in private equity. We have a very, very direct line with the management of our companies we own, and there's a really strong alignment with our management team. So it's about setting strategy, giving management access to capital, and letting them go and execute that strategy. And it's a very clear model, and that is very clearly what drives that outperformance. I think there's another aspect of the public markets that's important to talk about. One of them is this quarterly or 6 monthly reporting, and also that the companies are there forever. So they sort of actually are stuck between this world of short-termism and forever, where with a private equity company, we tend to have a time frame of 4 or 5 years, and so it means that you take a medium-term view, like a project view. So you're not really worried about the next 6 months, but you're also realise that at some point you will sell the business. So you have a project plan to transform a business over a period of time. So that governance model and that time frame that you can take, a bit of a longer term view, but not a forever view, really is what drives that considerable outperformance in the private markets.
Interesting.
I can just already feel myself get super excited about private equity by the end of this interview, because both of those things make so much sense.
Yeah.
Like especially the governance structure. I never really thought of that, but now I'm just thinking about the shortcomings of the public markets governance structure.
Yeah. And look, I think the public markets make a lot of sense for the big banks and big regulated businesses and the like, but for a lot of your sort of medium-sized companies that are on the ASX, or even the smaller companies on the ASX, they probably shouldn't really be there. They're not really set up in a way that's conducive to fast, good decision making.
Yeah. So despite this outperformance, private markets have been a little bit more inaccessible and just haven't been front of mind for a lot of investors for the past couple of decades, and that's led to an underexposure both in individual investors and in a lot of institutions. Yeah. Talk to us about that underexposure. Just how underexposed is the average investor?
Yeah, so I think, look, the large global institutions are actually sort of have about 40 to 50% of their portfolio in the private markets. Is actually substantial.
Yeah, wow.
When you then come all the way down to individuals, you're less than 5%, sometimes zero. Why is that? I think there's obviously an awareness element of that, but also there's you are investing in managers, so there's a lack of sort of transparency in terms of who are the good managers. So there's a sort of a manager selection challenge that an individual has. But also, when you're going into these private equity funds, traditionally your money's been locked up for 10 years. And that's a very difficult thing for an individual to commit to because, life circumstance change and all those types of things. You do want access to liquidity. So it's really those combinations, that have really caused particularly the individuals to be, massively under-allocated to the private markets compared to the public market or compared to institutional shareholders. And I think, there's some really interesting stats around the place. It's only about 2% of companies are public. 98% of companies are actually private, which makes sense when you think about, the way that business and industry actually works. And so, an individual that's only got public market exposure is actually exposed to a very small subset of the companies. And so you can see from an institutional investor perspective, looking for diversity, it makes a lot of sense for them to have a big exposure in private markets.
Awareness is definitely increasing, though. I think we do every year a bit of a check-in on how many companies are IPOing, and it's just getting less and less each year because more of them are staying in private for longer and then just getting scooped up by all the big private equity firms. So us as retail investors can't get them.
It does grind our gears when we see companies get taken off the boards, like good companies get taken off the boards. I'm like, damn, well, there goes that opportunity.
And you're seeing some real concentration, particularly in the Australian, public markets. You've got the big banks and resource companies dominating the indexes. So you've got to sort of really, and you've just had a bunch of building materials, in Boral maybe going or CSR going. So the sort of universe, available universe in the public markets is decreasing.
And now, now super funds are doing it. Like Sydney Airport gets taken off the board. It's anyway, that's a completely separate conversation.
I think it goes back to this governance issue that we were talking about.